Welcome back to the Dividend Diplomats YouTube channel. You got your boys here, Laney and Bert, the Dividend Diplomats. We have two undervalued dividend stocks that are in my portfolio. Metrics are looking pretty decent for these two companies. One's a legacy position in my portfolio, the other, one of my new additions here in 2024. Guys, we can't wait to talk about these two stocks and see if they are stocks to buy right now.
Smash that subscribe button, guys. Give us a nice thumbs up here. Let's get to that 20K mark on the subscription standpoint. 19,300 plus dividend maniacs rocking with us, guys. Almost there. Bert, two stocks here. I don't own either of the two, but you own obviously both. Both are probably fairly, young in your portfolio anyways. I don't know how long you've owned the one for, but I'm sure you'll go over it.
Mhm.
Yeah, I mean, I could see why you'd want to buy both of these stocks, guys, and I'll have to see if you guys own any of the two stocks here.
Yeah. So what we're going to do is we're going to run them through the screener, which features three metrics and that bonus metric: P/E ratio less than the S&P 500, payout ratio less than 60%, history of increasing dividends, and the bonus metric, the dividend yield. Now I know everybody you've been liking talking about each one of the metrics side by side for the companies. However, these are two completely different companies. So rather than just go metric by metric, we're just going to go company one, company two. Go a little old school. If you really hate it, let me know. We can fix that next time too.
Oh man, jumping right in, guys. Again, the first stock here is going to be very boring. It's going to be, though, a Dividend King, guys. 50 years of growing dividends. That's what it's about. That's kind of, what you want to hold in as a dividend investor in your portfolio is a company that relentlessly increases their dividend, albeit you want that increase to be at an above average rate, above the rate of inflation, preferably, especially in today's market. So Bert's got one. PE is low. I'm excited for you to talk about it.
Genuine Parts Company, ticker symbol
G P
GPC, the
C
secondary auto parts maker, the Napa Auto Parts, the auto
Napa
shops.
no.
Yeah, what I love about this company,
Bert loves Napa.
I well, there's some nice wine. I'm not gonna lie, there's some nice wine up in Napa. But what I like about this company versus our traditional car makers, Laney and I have always talked about how we don't buy auto, we don't buy Ford, we don't buy Honda, Toyota. It's a cyclical sector we have typically always stayed away from. Genuine Parts Company, on the other hand, is in the secondary market, the auto repair market. They offer over the counter parts to help people fix their cars. Now that is a completely different sector because people still have to drive, they still have to buy cars, they still have to fix cars. And with how expensive cars are today, more people are trying than ever to keep their car, keep fixing it, keep repairing it, and avoid having to spend on a new one. So companies like Genuine Parts Company are there to thrive.
Oh yeah, and especially when, I mean, not to beat around the bush, but especially when consumers' budgets are tighter, and costs are rising. Everybody's trying to stretch out the length of their car. I mean, hell, my car's just about 15 years old, still on the road, pushing towards that 200,000 mile mark here. I know Bert's is approximately 11 years, 12 years old. He's pushing 125, maybe
About 115. Yeah, my
115.
wife's
So,
is 10 years old too. Same idea. Stretching it, just trying to keep them going and avoid that car payment as long as we possibly can.
yeah, so Genuine Parts obviously is there to help out all those stores. Obviously, you're not going to a genuine parts store,
Mhm.
but they're there supplying all the pieces that you might need to replace a bulb, replace a battery, replace some brakes. Again, the 5 year average price to earnings on this stock, which again speaks to if it's under or overvalued comparative to the market. 5 year average lately has been 18 times. So we'll see what it looks like currently.
Yeah.
The balance sheet looks freaking solid with the current ratio well over one, and a quick ratio that, obviously they're built on inventory. So
Yeah, you're going to have to hold a lot of inventory, a lot of parts here to supply their networks across the world. Now, this one, Lanny, I will say from a historical purchase standpoint, this is the one of the two that I've owned much longer. I just pulled it up on Fidelity while you were talking there. I know exactly when I bought this company. I bought it. This was the first stock I bought when the pandemic happened. Remember when there was like the big drop down in share price for everybody, for all these companies out there? I focused on a king and I focused on quality, and that's why I bought Genuine Parts Company. And that's when we really made our move. It was in Q1 and Q2 of 2020. We built this position up and we own 32.8 shares now. The market value of this position is $4,500. So we're looking to see, should we be adding to it? Should we be growing that position here? Let's run through the metrics, Lanny. Let's see what Genuine Parts Company is looking like here. Current price is 138.26. Earnings per share 988. PE ratio is 13.99. So it's below, it's what, 5 points, however you want to say it, 5 points lower than that 18 PE ratio, that 5-year average that you cited a little bit ago.
Yeah, yeah, pretty low. Obviously because the last 12 months the stock is down 12%. But to dig into that dividend payout ratio, paying $1 per share per quarter, $4 a year, perfect payout ratio at only 40%.
Wow. At 40%, right at the
Nice.
bottom
Yep.
end of that. Perfect.
Keep growing that dividend.
Yeah, their 5-year dividend growth rate's 5.64%. They've increased it for 67 years. Yes, they are a dividend king. Not the highest dividend growth rate, but always solid mid to high single digit dividend growth, which is all you can ask for right now.
Yeah, consistency, goes well again with that dividend yield, which is at 2.89%. So you're well over, the 9.95 overall when you, or at least 8.5 when you get into the combination of the yield plus growth. I'm sure dividend growth will be a little bit stronger as well once inflation continues to cool and their EPS starts to expand a little bit more.
Yeah.
But yeah, I mean, 2.89% current dividend yield.
Yeah. And they're down over the last 52 weeks, 11.5%. They're pretty much flat for year to date. Over the last 5 years, they're up 45%. So people that have owned Genuine Parts Company for a long term are feeling pretty good about it right now. Um, but with the metrics, we'll put them up here. This recent flat and dip over the last 52 weeks has presented an interesting opportunity to buy a high quality dividend king in a time when there aren't very many values today.
Yeah, I mean, can't knock Genuine Parts Company. Obviously, a very much under the radar, boring stock, but in investing, boring is good, guys. It just keeps the engine moving, keeps the engine moving as we move into the second stock, that growth stock that Bert has been talking about this year.
Yeah, I added 5 shares to the stock in the middle of June. Subsequently popped right after, and it's been pulling back a little bit. Yes, we're talking about Salesforce, ticker symbol CRM, the newly minted dividend stock. They just announced their first quarterly dividend of 20 cents, and now they're an 80 of 40 cents. So now they are paying an annual dividend of a buck 60. Sorry about that, everybody. Salesforce, they're always going to be skewed a little bit. They're a heavy tech stock. We know what's happened with tech stocks over the last 5 years. There was the massive pop up in tech stocks. Now they're pulling back. So their 5-year PE ratio was 41x, and it's going to be skewed a little bit just because of that boom. What's interesting is it's face tough. The growth targets come down. People are concerned about artificial intelligence, how they're going to adopt it. So it really spooked investors, pulled that stock price down. So what's happening now, Lanny? They're starting to integrate the AI agent. They're starting to bring AI into Salesforce in a non-traditional, non-sexy kind of way because it's a lot of business to business. So it's going to be exciting to see what Salesforce can continue doing in 2024 and 2025.
Yeah, I mean, CRM guys, Salesforce, we're going to look at these metrics here. I mean, again, they are coming way down in price, not way down, but, kind of, not performing as strong as what the entire tech industry is doing right now. Um, you know, Again, Bert, you own 5 shares. Obviously, the stock price is high, $247.63. But I know we'll get into a little something too afterwards. But forward earnings right now to get in that first metric is 9.9 in EPS expectations. So that 25 times earnings. So historically they're at 40 times earnings. Now they're down to 25x.
That's even low for one of the massive growth tech stocks too. So it's always going to be expensive since the sector it's in. With that $1.60 annual dividend that they're now paying, that gives it a payout ratio of 16%, which is pretty much again in line with the sector. Tech stocks typically have lower dividends.
Yeah. Wow. 16% payout ratio. Obviously they should have plenty of room to continue to explode that dividend by, I mean, double digits. Like you said, I mean, they're only paying 40 cents a share a quarter. So I don't know, see why they couldn't do, going from 40 to 44 to 48 or to 50 or to 60 cents pretty quick, in the future here. So no real dividend growth quite yet, but the dividend yield, get ready, guys. This is really going to add a jolt to that dividend yield in your portfolio. Kidding. But 0.65%, but you're not buying it for the yield, you're buying it for the future growth prospects of CRM.
That's absolutely right. So they're down 3% year to date, up 8.5% over the last 52 weeks, and up 57% over the last 5 years. That's Salesforce, everybody. If it keeps hanging in the 230s, 240s, I'm going to nibble on them. I'll grab another share or two. I'd love to at least get to 10 shares before I consider at least full and then adding to it. I have some portfolio cleanup I can do. There's a few things I can do to dump a few dollars into Salesforce.
Bert's all about dumping a few dollars, guys.
Yeah. So
Again, I know you've got, yeah, that Solventum you might decide to sell off that doesn't pay a dividend. You could just, slide on over. Any
yep.
more thoughts to that, Bert?
Yeah, I only have 5 shares of it, so I'd pick up about a little under $300. That's about a share and a quart, a share and a yeah, 1.25 shares of Salesforce from there. Interesting. So, all right, everyone. We have Genuine Parts Company and CRM. We're gonna put them up there. Both are high up on my watch list for completely different reasons. Let me know what you're thinking of Genuine Parts Company, and let me know what you think of Salesforce right now.
Guys, come on. Would you buy Salesforce stock? Would you buy GPC stock? Do you own one? Do you own both? Let your brothers know here at the Dividend Diplomats. Guys, don't forget to like this video, subscribe to this gosh damn channel.
Yeah, and remember, you're either with us or you're against us, Jack.
That was Bert, the Hitman, and Lanny from the DD over and out.